Last month, when talking about stocks, I mentioned how we believed that the primary driver of market weakness, at least at that point in time, had been the persistently high levels of inflation. For much of 2021, the market had looked past that inflation with the idea that inflation would ultimately fade, or as the Fed stated, would be transitory. As that narrative was disproven, the market had to adjust. That adjustment, as we showed with this graph, was an overall revaluation of the equity market. As shown here, historically high levels of inflation have resulted in investors paying less for every dollar of earnings. Said a different way, all else being equal, higher inflation generally results in lower stock prices. As we all know, however, all else is rarely ever equal or doesn't stay that way. With stocks, things are always changing, and we'd argue that in addition to the revaluation of the market due to inflation, investors are now also starting to make assumptions around the future path of the economy, specifically the probability of a recession. The market now appears that they'll not only pay less for every dollar of earnings because of inflation, but are also questioning whether that dollar of earnings will end up being more like 90 or 95 cents due to a weak economy. Basically, the equity market is now fighting two separate but related headwinds. Daily market swings may seem to make little sense. But if we step back and look at the forest rather than the trees, there is actually some rationality or logic in what is occurring. Again, we don't expect that makes things easier or better, but hopefully it makes things feel less out of control. Nobody knows if the recessionary scenario that the market has begun pricing in will play out. But we want to leave you with some final thoughts as we contemplate the possibility. 1. Although real GDP growth was negative during the first quarter, economic indicators point to a solid increase for the second quarter. If a recession does eventually occur, it's not likely in the very near term. 2. Investors need to keep in mind that a recession doesn't have to be as deep or as destructive as some of the more recent ones. The pandemic and the financial crisis are understandably fresh in our minds, but it's important to recognize that those two recessions were also the two deepest since World War II. 3. In 7 of the last 8 recessionary bear markets, the stock market bottomed well before the economy. We may not know if a recession is in the cards, but the negativity seen in stocks recently may already have priced one in, which means we can still see upside from here even if a recession does occur. And lastly, stock market valuations are now broadly attractive, something we haven't been able to say for a number of years. As value-oriented investors, this last point gives us comfort and confidence that regardless of what happens over the next months or quarters, long-term future return prospects have improved and created opportunities that we will aim to capitalize upon. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video.